Have you ever wondered why money today is worth more than money tomorrow? This question brings us to the concept of the time value of money, an idea that's as old as commerce itself. Imagine you had $1 today. You could immediately spend it on something you want, or you could save it or invest it. If you choose to save or invest, that dollar has the potential to grow because of interest. It could become $1.10 or even $2. Now, if you were offered that same dollar tomorrow instead of today, you'd lose out on that potential growth. It's like watching a cake bake. You could eat it right away, but if you wait, it becomes something more delicious. That's why $1 today is worth more than $1 tomorrow. So, in essence, the time value of money is the reason you'd prefer to have $1 today rather than tomorrow. Ever heard of Aesop's fable, "A bird in the hand is worth two in the bush"? This ancient wisdom perfectly encapsulates the concept of time value of money. Imagine the bird in your hand as the money you have now. It's a sure thing, you can feel its weight, see its color, count its worth. But the two birds in the bush, they're like future money. You may be promised them, but they're not in your grasp. They're uncertain, shadowy, and may fly away before you can catch them. This is the risk involved in waiting for more money in the future when you can have a sure thing now. Now let's add a dash of humor to this. Warren Buffett, the Oracle of Omaha, and one of the world's most successful investors, once quipped he'd rather have the birds in the bush, depending on the interest rate and when he will get the birds in the bush. A chuckle-worthy twist, isn't it? But within that jest lies a kernel of investment wisdom. Buffett's point is about risk and return. If the potential return, the two birds in the bush, is promising enough, and if he's confident he can catch them at the right time, he'd be willing to wait. This is the very essence of investing. It's about assessing the potential return against the risk and the time it takes to achieve it. If the interest rate or return is high enough, waiting could indeed be more fruitful. The bird in the hand, the money now, is a sure bet. But the birds in the bush, the potential future money, could be even more valuable given the right conditions. And that's the gamble, the dance, the thrill of investing. It's about balancing the value of the certain present against the potentially more valuable yet uncertain future. As you can see, even the world's most successful investor, Warren Buffett, appreciates the time value of money. So, how does this all relate to investing, specifically when it comes to valuing stocks? Well, investors use the concept of time value of money in their decision-making process. It's a bit like being a bird watcher, but instead of binoculars, they use a tool called discounted cash flow analysis. Let's break it down. Imagine you're looking at a company as a prospective investor. You're interested in the future cash flows the company will generate. But remember, $1 today is worth more than $1 tomorrow, so those future cash flows need to be discounted back to today's value. Here's where it gets interesting. To do this, investors use a discount rate. This rate represents the return you'd expect from a similarly risky investment. Think of it as the interest rate on a bird in the bush. So you've got your future cash flows and you've got your discount rate. Now it's time to do the math. You divide each year's projected cash flow by 1 plus the discount rate raised to the power of the year. This gives you the present value of each cash flow. But we're not done yet. You then sum up all these present values. The final figure is what we call the intrinsic value of the stock. If the current market price is less than this intrinsic value, the stock may be undervalued and it might be a good buy. If it's more, the stock might be overpriced. Of course, this is all a bit of a simplification. There are other factors to consider like the company's growth rate and the stability of its cash flows, but hopefully this gives you a basic understanding of how investors use the time value of money to value stocks. So there you have it. The time value of money is a key concept in understanding and valuing investments. Remember, a bird in the hand may be worth two in the bush, but the bush might be worth checking out depending on the interest rate.